What's up, investing aliens? Eric here. I've got a great video for you today breaking down the Magnificent Seven. I've had several people ask me, hey, are those stocks still buys at these levels? What's going on? Now, Jim Cramer just talked about the Magnificent Seven last night, so this is a great segue. We're going to dive into each stock. We're going to look at the valuation, a chart. I'm going to give you some overall thoughts on each of these seven stocks. Let's go. Okay, so this is just last night, Wednesday, November 8th. Jim Cramer examines why the Magnificent Seven tech stocks have seen volatility in the market. Now, if you followed me for a while, you know that these are core positions in my $1.5 million growth stock portfolio. I've owned all seven of these stocks over the years. Currently, 6 of the 7 are core positions. And essentially what I own is profits, and I'm letting it ride. Not on all, and I'll go through each stock. So first, what are the Magnificent Seven if you're not familiar with the term? Alphabet, Amazon, Apple, Meta, Microsoft, Nvidia, and Tesla. Essentially what Cramer is saying last night is it's been hard to stick with these stocks. You had to fight so many trends, so many obvious points, so many outspoken naysayers. Remember, as obvious as these winners seem in retrospect, it's been very easy to get shaken out. Talking about antitrust with pretty much all these companies, but especially with Alphabet and Amazon. Apple, to Cramer, Apple received downgrades from some on Wall Street due to declining hardware sales. You saw some slowdown with Apple iPhone. Meta concerns, slowed ad revenue. That's always a concern. That's the thing with Meta. That's the one stock that I don't own. I have owned it. I made profits. I sold it. I don't own it now. I generally avoid stocks that are basically apps. The thing is, you've got really no recurring revenue. So every single quarter, Meta's got to go to bat to get more revenue. And if you own Meta, there's nothing wrong with the company. I do like the business, but just sharing my thoughts of why I currently don't own it. I made my profits since IPO. I took my profits and I'm good with it. Microsoft, there's always drama with all these companies, but these are great long-term investments. And you're wondering, if you're watching this video, hey, can I still buy these and make money on them? Nvidia, of course, you got to worry about the geopolitical risks with China and with, China invading Taiwan and relying on Taiwan semiconductor. And you know the whole story there. And then Tesla this recent quarter, a lot of people didn't like the quarter. I think you see some CapEx spending, and they're really spending money in the last couple of quarters to try to ramp up production in their factories. And this is really about future growth. So you will see benefits from that later on. But right now, the company is focused on growth, and it's focusing on that network effect, lowering prices so that more people can buy the cars. If you've been following Tesla in the channel, you know that pretty much every automatic manufacturer, just recently Lucid, but every day it seems like over the last several months, a new auto company comes out and says that they're going to follow the Tesla charging standard. And of course, Cramer calls Tesla a cult stock, and there are other stocks like that. I would say Palantir is one of those as well. And I own Palantir as well, and I'm a bull on Palantir. So I'm going to go through each of these stocks one by one. We're going to give you an earnings snapshot of what happened on earnings, talk about valuation, look at a chart, and move on to the next stock. So this is on Morningstar. Alphabet here, fair value estimate according to Morningstar, $161. Morningstar rates it as a 4-star, and it does have a wide moat. Uncertainty rating, high. Of course, there's always drama around these mega cap tech companies. Antitrust could be a concern. A lot of times we talk about antitrust, how if you break up a company like an Amazon, like an Alphabet, oftentimes you'll see shareholder value be unlocked by that. So it doesn't really worry me all that much. So earnings recap on Alphabet, Google. Revenue and earnings growth were both better than expected, but the stock traded down on concerns that its cloud business is growing more slowly than Microsoft's. The thing with Google Cloud, we know that it's number 3. Amazon Web Services is first, Microsoft Azure second, and then Google Cloud Platform. It doesn't really surprise me necessarily that, say, Microsoft is taking share from Google if you understand the 3 businesses. I think that Google Cloud Platform still has runway for growth, but Google also has its hands in many other pots. Just like all these mega cap tech stocks, they're basically conglomerates, almost like mini ETFs. We're going to switch gears here, go to Seeking Alpha. So this is going to show you the top. This is the non-GAAP PE ratio. This is TTM, so 12 months trailing. This is 25.31. Since we have GAAP, we're going to look at GAAP. So PE, GAAP, TTM, 25.3. Forward GAAP 22.96. So you kind of have to take these ranks with a grain of salt, in my opinion. Valuation is a D. Well, is it really a D based on, Google, and you look at historically what it's traded for, what the opportunity is, what the TAM is, and so on. So I don't look at something like this and say, oh, it's a D, I can't buy it. That's not necessarily how I buy it. I look at many different tools. I call it tools in a tool belt to analyze a stock before I make a buy. And the PE ratio is a nice quick glance, but it's not the only metric that you're going to look at. So you're going to look at things like profitability. Gross profit margin. This is a B minus, 56.12%. Cash from operations, 106.48 billion, A plus. You'll notice that the majority of the Magnificent Seven, that basically all seven of them have very strong balance sheets. They've got, great cash flow, free cash flow, profitability. Those are the type of stocks that are popular in this type of environment. When there's uncertainty, those smaller companies that are burning cash, that don't have a lot of cash and cash equivalents on hand, those are going to be higher risk, and the market's not going to want to put money into those names as much as these, mega cap tech companies. Looking at the growth though, we talk about how there's really a spectrum, and you have spec stocks, you've got hypergrowth, growth, mature growth. Now I consider Alphabet more mature growth. And, obviously too, if it's over $1 trillion market cap, it's much harder for a company to go from $1 trillion market cap to a $10 trillion market cap. But the revenue growth year over year, you're looking at 5%. Forward revenue growth, 9.71%. So it's still growing at a decent clip, but it's not, hyper growth. It's not growing at a rapid rate. Now, you guys have heard me say this before, but with Google, you can buy A shares or you can buy the C shares. I prefer A shares. That's GOOGL. That's the chart we're looking at here. You can also buy the C shares. That's GOOG. The only difference really is going to be voting rights. If you don't have a ton of shares, it probably doesn't matter. Now, if you look at this, we do chart day every single Wednesday in Patreon Discord at 9 o'clock a.m. Eastern, and those are recorded. When you see orange, that's a previous chart day. Yellow is going to be today's chart day. In fact, this should be orange because we didn't do chart day today. This is all going to be previous information that you're going to see today in orange. If you look at the stock, it basically hit about $120. And we said earnings are going to be critical. We talked about it before. Earnings, Alphabet does not guide. In fact, this is from a YouTube video, and I said 146.70 is possible on upside. So I did a earnings recap on Alphabet, and we showed this chart. So if you look at the upside on this, R3 is up here at 149.52. I think it would get heavy resistance at $150. Looking at the moving averages, this is the 200-day moving average here in purple, 100-day here in red, 50-day moving average here in the yellow. So it's working its way back to that 50-day moving average. It bounced off the bottom of this Fibonacci retracement. You can see the support 3 is down here at $107. That would have been a good opportunity if it would have come down in this range. It didn't. But with all of these stocks, you'll notice that, obviously they've ripped. This was January 6th of 2023. It was a $85 stock, and it ripped from 85 to 141, pulled back to 120. Now it's sitting at 131. So is the stock a buy or not at these levels? I don't think it's a terrible buy long term, but honestly, for me, this is more of a hold. If it's something that you're bullish on, you probably add it back here and along the way. I would much rather have you buy some shares, at $120 or $130 versus $140. And I do think that there's upside. So hear me say this. If the market stays bullish, all the stocks that we talk about today, they're probably going to go higher. If the market breaks down, think about it. These stocks are major weights in the indexes, in the S&P 500, the NASDAQ composite, the QQQ ETF. If the market sells off hard, these stocks are going to take a hit. So if you've got a 5 or 10% correction like we just saw, these stocks are going to come down. Now, these are still very much in fashion. They're still popular. If the market stays bullish, you're going to see momentum. I think you can see the stock closer to $150. So back to Morningstar, Amazon, they've got the fair value estimate at $155, also 4-star, also wide moat, also uncertainty rating high. Pretty much the same that we saw at Alphabet. Third quarter results were good. E-commerce related revenues all coming in ahead of our estimates. The same was true for advertising. We talk about the advertising segment of Amazon bringing in more revenue than YouTube at this point with advertising. So it's a pretty big thing that a lot of people don't recognize or notice or realize. Amazon Web Services was a little bit light, but it was a very, very small number. Overall, it was a beat on everything except a slight miss on AWS. Now, Microsoft Azure actually came in higher than expected on cloud. And then Google Cloud Platform, like we talked about, came in a little bit light, significantly lighter than AWS. So what that's really showing you, I think that overall cloud's doing okay. Microsoft is doing really well. Amazon Web Services is still the king, and they're still growing fine. And considering the economic conditions, all three of them did pretty well, with Google being, the lowest performer of the three. So Amazon stock has run up hard this year, gaining 70% from January. Given the firm's wide moat and good secular position, we think it's another name. On the surface, it's pretty easy to buy, though worries about customers may make other software names more attractive, and valuation as well. So actually, let's go back to this. I want to show you something really quick. Let's go to charting. and I'm going to go to year to date here. This is going to show you Alphabet, Google compared to the S&P 500. So Google's up 47.25%, S&P 500 year to date 14.61%. The article said Amazon up 70%. On this, it's a little bit lower, 65.56%. So still an amazing year. This is year to date. S&P again, just under 15%. Now looking at the valuation on Amazon, you're going to get an F. And this again is why you don't just look at a P ratio and buy off of that. And I will admit that Amazon, isn't a cheap stock. It's a, if you look at the gap, PE, the TTM, you're 74. The forward is a 55.35. All the other metrics like growth, profitability, momentum, you've got A minus, A plus, A plus, doing really good overall. You look at the profitability, you've got the gross profit margin, 46.2%. The CapEx to sales, 9.88%. Cash from operations, TTM, is about 71.65 billion. And then growth is a little bit more than Alphabet, but still, again, this is more of a mature growth company, 10.32%, forward 10.61%. So it's still a growth company, but it's mature growth. You look at the market cap, $1.66 trillion for Alphabet. Can the stock grow? Can the company grow? Can you make money? Absolutely. But it's much harder, again, for a company to go from a $1.6 trillion market cap to, say, a $10 trillion market cap. Amazon, same deal, $1.46 trillion market cap. And this is showing a 74 P ratio here on Google. But if I were to ask you which stock has a higher market cap, Amazon or Google, and which should have a higher market cap, I think some people might guess that Amazon is trading at a higher market cap, but it's actually the wrong answer. Again, Alphabet $1.66 trillion, Amazon $1.47 trillion. Okay, so Amazon got down to $118 here recently. This was probably an opportunity to add, and we circled this before earnings saying that, if earnings are bad or something, it'd come down to this 200-day moving average. Obviously, the 200-day moving average is higher because it moves with time, but it did come back to that 200-day moving average, didn't quite get to the S3 at 112, and it's popped significantly. You look at this, $118, trading up today about $141. So if I look at this, it's pretty close to Alpha. We said $150 is possible. This R3 this is a previous R3 over here, 154. The current R3 is 144.74, and we got resistance just before that. So oftentimes you see these big pops, you're going to have consolidation, and it could come back, lose 50%. You see a retracement sometimes 50%. Or if the market stays bullish, you're going to see a continuation. It probably breaks 145 and then probably 150, 155. Would I buy the stock at these levels? No, I wouldn't actually buy Amazon at these levels. I did like the stock a lot on $100, especially in that 80 to 85 range when it got back here. Just in March of 2023, this stock was even, $87 a share, ran from 87 up to 145 like a lot of these, pulled back, and now it's kind of popping again. All right, so Apple, this is an interesting one. Earnings were interesting on Apple. The fair value estimate for Apple is $150. Now, this is actually lower than what it's trading at now. The other two that we looked at, it was the opposite. Now, Morningstar rating, it's only going to give Apple a 2-star rating. You notice in the last two, a 4-star rating, also has a wide moat, also has high uncertainty. So Apple reported solid fiscal fourth quarter results while providing investors with a decent outlook for its fiscal first quarter. Revenue was in line with expectations, but modestly below estimates here, which we think contributed to the 3% sell-off after hours, and then basically it's recovered since then. Looking at Apple, $2.85 trillion. At one point, it was over a $3 trillion market cap. Valuation, according to Seeking Alpha, this is a C minus. So if we look at the gap, PE, TTM, 29.84. If you look at historic PE ratios, this is still trading, pretty high. And there are a few reasons for it. Number one, a lot of investors look at this as a safe haven. It's got basically the strongest balance sheet on the planet. It's bulletproof, tons of cash, right? Apple has $162.1 billion in cash. Okay, so remember that number, $162.1 billion in cash is what Apple has. Now, the Dallas Cowboys are worth $9 billion. That's number one according to Forbes, World's 50 Most Valuable Teams 2023. So the Cowboys are at $9 billion, the Yankees $7.1 billion, the Golden State Warriors $7 billion, New England Patriots $7 billion, the Rams are worth about $7 billion, 6.9, the Giants are worth $6.8 billion, the Bears $6.3 billion, that might surprise some people, the Raiders $6.2 billion, also might surprise some people, the New York Knicks $6.1 billion, the Jets $6.1 billion, Real Madrid $6.07 billion. Let's just look at those 11 teams. What's number 10? Okay, so this is a typo here. This should be number 10. Let's look at the top 10. The Jets should be number 10. We're going to take the top 10, we're going to add that up and see how many teams Apple could buy. Okay, so I added those 10 teams up, $68.5 billion. So Apple could basically buy the most expensive, the most valuable, the top 10 teams in the world and have $100 billion left in cash. Not quite, it'd be, $93.6 billion, but still, it's a massive stat if you think about it. Now, of course, profitability, Apple's very strong in that department as well. So amazing free cash flow, profitability, cash on hand, etc. We looked at the valuation. Look at growth, negative 2.8%. So, obviously when you have a growth stock, this is going to be a dividend paying stock. So it's a little bit different, right? Because the first two companies we talked about don't pay a dividend. So this is going to fit more in a DGIF versus a mature growth. That spectrum goes, you start at spec stocks, it goes to hypergrowth, growth, mature growth, DGIF, DGI, and income. So Apple is further along that spectrum, basically, when you think of the life cycle of a business, and it's more of a DGIF type of a stock. But at the same time, the dividend yield, because the stock is so expensive, I remember when this stock used to pay over 2% dividend. Now it's 0.52% if you buy it today at $183 a share. Looking at year to date, Apple's up 46.23% versus a little less than 15% on the S&P 500. Again, you're going to see orange. These are previous chart days. They could be weeks old. We don't cover these mega cap tech stocks too often on chart day, to be honest with you. If you want to join us live every single Wednesday at 9 o'clock a.m. Eastern, we look at charts. I cover QQQ and 20 individual tickers that are chosen by community members. We do live streams every Monday, Wednesday, and Friday at 9 a.m. Eastern. Those are recorded. Check out patreon.com/firedupwealth. We have a 7-day free trial. You have nothing to lose. Go try it out. Check out Discord. See what it's all about. Now, a lot of these stocks, you'll kind of see this slanted, almost like it's not a very sexy triple bottom. This one especially, because it's got more of a slant. You want this straighter, but you can see it's kind of bottomed out and popped. And a lot of times you have this channel. I mean, you look at this channel, it's actually kind of a downward channel. So it's probably going to go higher, because if the market goes higher, a stock like Apple, which has major weight in the indexes, is probably going to go higher. Do I like Apple? Yes. High quality company. Do I like it at $180 a share? Well, I like it better than when it was at $198 a share, but you could have bought this stock in January 2023, just this year, $124.17. Now it's $180 a share. So for me, this is another one. It's a hold. I would not be buying it. For me personally on Apple, $150, I would not pay over that. In fact, $150 is, that's where I would start nibbling if it even got there. But I would prefer this stock down in these, ranges, probably like 125 to 145 if I didn't own the stock already. Now, I've had this stock since 2015, basically all house shares. And I'll just put it up on the screen here. You can see my top 10 holdings, and this is by concentration. And you can see that the Magnificent Seven is a big chunk of that. These are core positions, again, that I've owned for a long time. Majority of this is going to be house shares. The exception, you can see Snowflake there. I'm actually down about 7% on Snowflake. So I'm not perfect. I didn't get the best price in that new IPO. And I was really excited about the company, and I overpaid a little bit. Now, long term, not worried about it. In fact, if the stock comes to certain levels on Snowflake, I'd probably add more. And I look at Snowflake as kind of the next generation. You think of these FANG type stocks, these Magnificent Seven. And I'm not saying that, Snowflake is going to be a guaranteed slam dunk, that it's $1 trillion company or anything like that. I just look at it more as a hyper growth, more of that younger growth company that could grow into something much larger later. So with Apple, it probably goes up to $200 again. It's going to have to retest that 198. If it breaks that, you could see it up to 210 or something like that. You just have to be careful, I think, chasing some of these names. You have to be patient as a long-term investor. If you're a trader, it's a whole different story. We're looking at these charts here as long-term investors, buying stocks, dollar cost averaging, generally holding for 5 or more years. So the one stock that I don't own, I've owned this in the past. I made money. I sold it. I don't own Meta Platforms right now. According to Morningstar, the fair value estimate, $322. This is a 3-star rating, wide moat, also uncertainty high. Now, the third quarter results were good. Strength on all fronts, user growth, engagement, and monetization with leaner operation. That's what you want to see. So I've got nothing really bad to say about Meta Platforms. If you own it, I think it's great, whatever. It's just not something that fits in my current blueprint, what I'm trying to build. So Morningstar basically increased their fair value to $322 from $311, and it's trading at $321. And this one actually is under $1 trillion market cap. It was over $1 trillion, of course, at one time. Now it's $826 billion market cap. According to Google here, 28.95 P ratio. Looking at year to date, Meta is up 156%. So congratulations, bulls, on that. S&P 500 only 14.6% again. So this is absolutely crushing it. You can see in the orange. Valuation, Seeking Alpha again. You're not going to buy solely off of these valuations, but the valuation's a D on here. Now looking at the PE, the gap, TTM 28.28. The forward 22.23. So I've seen a few people online say this is the cheapest of the Magnificent Seven. I think probably using this forward gap PE ratio of about 22. Profitability A+, solid numbers here across the board. So obviously this stock had volatility when it started to spend a lot of money on metaverse. And advertising, of course, slowed down too. You look at the macro and so on. We won't go into a whole bunch of that right now. You guys know the story. But just looking at this chart, it's another one. It's not a perfect double bottom because it's slanted upwards, but it basically is like a double bottom at a slant, and it popped up. And it's kind of trading in this channel right here, and probably needs to break above this. R3 would be about $355. So I think, again, if the market stays bullish, this one goes higher. Would I buy it at these levels? Personally, no. This obviously was a great buy if you got it back in November at $88. And I'm not showing you this to say like, oh, you silly goose, you should have bought it at $88. What were you thinking? Now, if you were in Discord, you were buying a lot of these stocks, these levels, because that's what we do. We try to set people up and give them prices that we think are attractive. We don't give financial advice, but we give opinions, we give data, we provide charts to help investors make better decisions, be a better investor. This is an epic run. It's going to consolidate and probably grind a little higher, but I personally just don't buy stocks on charts like this. I generally will buy here or an uptrend, but I look at the valuation. Is it the cheapest of the Magnificent Seven? You could probably make the argument. Although this specific business doesn't have that recurring revenue, we could go down a whole nother rabbit hole of why it should actually not be higher in terms of the valuation, because it's going to rely on ad revenue, which is going to be cyclical, and it's going to start over every quarter. But that's a whole nother story. We could talk, a long time about that. But for Meta Platforms, for me, it's probably a hold to a moderate buy if you really like the company, because it probably will go higher and it maybe isn't crazy expensive, but personally, I'm not buying at these levels. Microsoft, one of my favorites, long on this stock since 2012. So I've got an amazing cost basis. Yield on cost is, over 7%, something like that, doing really well. The fair value estimate here on Morningstar is $370, 3-star rating, wide moat. Now this is interesting. The first one that's not high on uncertainty rating, it's a medium. Microsoft reported good results and guidance for its fiscal first quarter 2024. The company is firing on all cylinders and exceeding expectations. All segments were better on the top end of guidance, with intelligent cloud, Azure, and more personal computing, Windows, and gaming that's coming back strong. Azure grew 29% year over year versus guidance of 26%. So you look at Azure Cloud, 3% beat on the guidance. So that's 2 quarters in a row of strength plus good outlook. Margins were once again very strong as well. However, shares are up following earnings, leaving the stock just inside that 3-star territory. So a lot of these are going to get lower stars because of valuation. Microsoft is a name we want to own, but we don't see a huge valuation layup here. I think I would agree with that overall. Obviously I've owned the stock for a while. It'd be really hard for me to buy this at 363. I remember at one point during the pandemic, 2020, like there's no way it's going to get below $150. If it gets below $150, I'm pounding the table. It got to 137. Didn't think it was going to happen, but at the same time, you guys know me. Anything's possible. Nothing surprises me. But under 150 was like, if it gets under $150, you got to buy Microsoft. Boom, 137. A lot of people did buy at that price point and did pretty well. Same story in 2022. Like, there's no way Microsoft's going to go below $250. It's not going to happen. Well, it got to 235, 221 even. If you bought it below 250, you're feeling pretty good about life at 363. This is a $2.7 trillion market cap. It also pays a dividend. So this is a great stock because it's paying the highest dividend out of all the 7 that we're going to talk about today. It does have that $2.7 trillion market cap, but the yield's 0.83%. Not a massive yield, but it's higher than Apple's. A lot of people might be surprised by that. So looking at Microsoft chart, up 51% versus that S&P again at 14.61%. Valuation, it's going to be a D. Again, you don't buy just off of this, but it's good to look at. So that PE gap, TTM 35.19, the forward 32.59. Profitability, A plus again, 69.44% profit margin, gross profit margin, strong numbers for the most part across the board. Growth, again, this is a different spectrum. This is going to be a DJIF stock. Revenue growth, 7.5%, forward 11.68%. Now, I really like to see dividend paying stocks that are growing still at that, 10, 11%, looks like almost 12% on that forward guidance. So if you've got strong balance sheet, strong profitability, paying a dividend, this is the kind of stocks I want to own, especially if I bought them way lower. I bought this stock in 2012. So I've got an amazing cost basis. It's house shares. I'm letting that yield on cost stack, and it's been an amazing investment. And this is why DJIF stocks can be so powerful, because compounding is the eighth wonder of the world. Okay, so on a previous chart day here in orange, we said $316 support, upside, possibility of $350 plus, R3, 353. It crushed past that. In fact, it's new R3 because these R3s will update. These are pivot points. The new R3 here is going to be at $366.83. And a lot of times you see resistance right before that and some consolidation. But this is another one you can see. This is the closest double bottom we're going to look at. 311 and 309.45 basically. This is a double bottom pop off of that. But again, same story. You guys know the drill. January of 2023, this was a $219 stock, went up to 366. A lot of these basically, they doubled from their lows to their highs, pretty close to it. But this consolidated down then from, $366 a share down to $310 or so. And now it's trading back at, $363 again. So it's going to get resistance. It's going to have to break past that. You could easily see this consolidate and come back in the middle of this channel. I wouldn't be surprised. But at the same time, again, if the market stays bullish, these stocks are major weights in the indexes, and if the market goes higher, these stocks are probably going to go higher along with it. Is the stock a buy at these levels? I wouldn't buy Microsoft at these prices either. For me, honestly, I was saying under $300 is probably where I target, but the problem is everybody wants to own it, and you probably won't get a chance to buy it unless something happens, like if they have an earnings miss, but then, the momentum is going to go down, and you see what happens. A stock is hot until it's not. As soon as it's not, then, you could zoom the chart 6 months in the future, and the stock is much higher, but then 6 months later, it's right back down in these prices. So you just have to avoid that FOMO, that fear of missing out. Don't chase, be patient. I do like this company a lot. I personally am not buying it at 363, but again, it probably goes higher. All right, two more. So Tesla, fair value estimate, $210. That's interesting. Okay, let's take a look here. 3 stars for the Morningstar rating. Now, this is the first one, I believe, that is not a wide moat. In fact, it's the only one of the 7, because you can see NVIDIA down here shows a wide moat. This is saying that Tesla has a narrow moat. So essentially, Tesla doesn't have a moat. There's tons of other competitors that can do exactly what Tesla can do, is what Morningstar is saying. I disagree. You guys can watch the channel and find tons of Tesla videos that will tell you why I disagree. Tesla's results were below consensus estimate as the company's price cuts weighed heavily on profits. The market was expecting price cuts to result in another sequential profit margin decline versus the second quarter, but the extent of the decline was worse than anticipated. The much anticipated Cybertruck finally has date for deliveries. The company continues to invest heavily, et cetera, et cetera. You can read it. But the thing about Cybertruck too, then Elon Musk on the conference call said, we dug our own grave because we're making something that's hard to make, hard to produce, mass produce. Tesla is one of those love-hate stocks. It's polarizing. Musk is polarizing. You're either a bull or you're a bear. All right, Tesla year to date, up 101.77% versus that S&P, about 15%. Valuation, an F. I think that's the first F we got. So PE gap, TTM, 71.65. The forward is 83.88. This is going the wrong direction. Growth, they have a B+, profitability A+, momentum A-, valuation F. So profitability, at this stage is where the company's at. I think it's decent. When you think of margins, it's a little bit harder because automotive, that makes it tricky. Now growth, this is, 28.13%. So this is what I would call a growth stock. In my opinion, it's somewhere between it's past hypergrowth into growth, the beginning of growth. I think there's tons of room for growth still. And this is where it can get tricky because people say, well, I think it's a you can label a stock however you want. It's somewhere between hypergrowth and growth, but I would classify this stock as growth and not hypergrowth for several different reasons. reasons, but this is a company that, again, you either love it or you hate it. Let's look at a chart really quick. On a previous video, I said, if I didn't own Tesla, I would buy some, 210, 200, and 190. I also said it in Discord several times. If it comes back down, you have opportunity to add. And this is how I like the dollar cost average. You got to do what's best for you. I think under $200 is a good range to accumulate shares of Tesla. The problem with this stock is it's always going to have volatility. So if you said, can the stock be $175 6 months from now if something goes wrong? Absolutely. And this is going to be one that's going to have probably the highest beta and most volatility out of the 7 names. Although Nvidia might be a little bit higher just because of how hard it's popped over the last year or so. We'll look at a chart on that one as well. So do I like Tesla at $215? Is it a buy? I do think it's a buy, but not all in. It's a dollar cost average area. If it gets, under 225 is kind of that range. If it gets under that range, it's $10 less than that right now. I think if you're accumulating that range, but save room in case it goes lower, I think it's an okay, in my opinion, it's not a bad place if you don't own any Tesla to start a position. Most of the people watching me, they own Tesla at much lower prices. This got down to $101.81 or whatever, basically $102. Went from $102 to $299. So year to date, a lot of times it looks a lot different than if you actually take the low, the very low, which is a couple days later. But it's neither here nor there. It's ripped, from that $100 range basically to $300. Now it's pulled back closer to $200. This is an area that I'd accumulate, but expect volatility with this. And either you love it or hate it. So you're going to listen to this and think, this guy's out of his mind. Why would I pay $215 for Tesla? I think in 5 years, you're going to be happy with that, but I could be wrong. And a lot of people would be wrong with me, right? And Tesla is actually I think it's the lowest market cap of the 7. So $671.91 billion. This was over $1 trillion company at one point, and it will be back there at some point. This stock will be back over $300, but it might take some time. Now, Nvidia is the only stock out of that Magnificent 7 that has not reported earnings yet. So earnings are scheduled for November 21st. So it's going to be hard to cover this one, but we'll just go over it really quick. Fair value estimate, $480, 3 stars, wide moat, uncertainty rating, very high. Not just high, but very high. So Nvidia up 225.35% year to date versus S&P 500 at 14.61%. Nvidia is a $1 trillion semiconductor company, of course, getting more into software now, but $1.18 trillion. It does pay a dividend, but it's basically insignificant, 0.033%. And this is showing a P ratio of 115.82. Now, what's interesting, if you look at the forward, it's 48.55. So that's a big difference. This is showing the PE gap TTM 112. The forward is 48.55, meaning it's growing into that very quickly. Profitability, A+, strong across the board here. And then growth, what's interesting is you've got 9.9%, but then forward revenue growth is 43.5%. So this is very unusual because you're having this hyper growth kind of phase because of AI. And the question is how long does that last? And how many competitors come in? Now, I'm a bull on Nvidia. I've owned this stock since 2018, bought it in the 30s. You know the story. It's all house shares. I've been a bull on this stock. It's been my top pick really since 2018. I've been talking about AI since way before the markets were talking about Nvidia and AI. So if you want some real talk on Nvidia, I got you covered. Here's the thing with Nvidia. Now, if you look at last quarter, you essentially had this huge pop in revenue. Now, if you look at the expenses, so when you think of what Nvidia is, it's a fabulous semiconductor company. It's getting more into software. But let's just talk about the AI chips, H100 chips specifically. So they're going to take those chips to Taiwan Semiconductor. That's the foundry. Taiwan Semiconductor is going to produce those chips for Nvidia. If they're selling a ton more chips, of course, expenses are going to be higher. So what we saw last quarter is that not a massive amount of additional chips being sold, but those same chips being sold at much higher prices. The question is, how long can Nvidia do that where they kind of have a monopoly as an AMD starts rolling in, other companies like Intel try to play catch up? How long can Nvidia continue that? And so we really need to see this quarter to see, have they been selling tons more chips and still selling them at high prices? As those prices come down, what does that look like? What's the bell curve look like? And we just don't know the answer. So it creates a lot of uncertainty for Nvidia. And this is kind of the range you're in. I circled this a while ago. It said, I could see the stock at $350 and I could see it it's $600. Nothing would surprise me. I really think if you don't own the stock and you didn't buy some, here or way back here, you probably have to wait for earnings and just see. I think this is one you have to be careful with. I think this stock could easily run up a lot. I think it could go to $600 or $700, but I also wouldn't be surprised if the stock was $300 or $350. And some people, this is going to be another polarizing stock. Either you're a bear or you're bull. So you're watching this thinking, oh, this is a $100 stock. And a lot of people that say that's because they missed the run and they want the stock to come down because they want to buy it. Remember, everybody's got an agenda. But it's hard because this stock you could have got for a lot less. And if you were in Fired Up Wealth, I was pounding the table, like breaking the table, even at $150. And then, of course, the stock went down. It went from 150 to, $100 a share, whatever. And I had somebody, I shouldn't even say this on YouTube, but screw it. I basically had somebody give me like a death threat because he bought Nvidia at $156 a share and it went to $100 a share. Well, if he held on to that just, 6 or 8 months after that conversation, now the stock is still trading at $476 after massive volatility. So at the end of the day, obviously make your own decisions, do your own homework. And I'm not your financial advisor, but even if you bought it at $156, if you wouldn't have panic sold, you'd be sitting in a pretty good spot. And this person had a lot of money in this stock. So, I mean, that's part of being on YouTube. Like I said the other day, people are going to take credit when something goes right, whether it's their credit or not. And if something goes bad, oftentimes you're going to get, blamed past the buck. If you're watching this channel, everything I do is to try to help you make decisions to be a better investor. It's not financial advice. Make sure you make your own decisions, do your own homework. If you're new here, subscribe to the channel, click that bell for notifications, drop me a like, drop me a comment. Have a great rest of your day. Take care.